a viewer or a listener who's looking at this right now and he's wondering, what should I do, fixed or floating? He wants to take a house.
Fixed rates are a little higher than the floating rate.
I want to get into how to choose a good home loan.
The regulations get tighter, yet consumer friendly.
Home loan is a fairly complicated product as compared to, say, a credit card where you just sign up, start spending and repay and that's it.
But a home loan you are committing for the next 15 to 20 years of your life.
If you've got a 10-year or a 15-year loan product, a lot of things can go wrong in your life.
People don't want to take a liability upfront, huge liability. They want to enjoy, they want to spend a little till the time they are a certain age.
I mean, if you continued a little bit more, I would have thought that you're trying to arrange for a spouse or a marriage proposal out here. Okay, the kind of list of things that you're proposing, very interesting.
It's almost getting married to the home loan itself.
Hello everyone and welcome to Mind Your Karza by One Finance, a show where we help you understand and improve your relationship with loan products like home loans, credit cards. Today's episode, we go one step further within home loans. My guest, Abhinav Kaul, Senior VP Partnerships at Bank Bazaar. Abhinav, thank you so much for doing this for our viewers.
Thank you, Anupam, for having me here.
Great.
It's a pleasure.
So, I want to understand home loans as a product. They've been around, I think HDFC was probably the one that started it all in the private sector. How has the product evolved? Like here we are in 2024 versus what it used to be. Maybe what are some features that used to not exist before that have made it more customer friendly and maybe the viewers do not know about it. So just overall evolution of home loan.
So, Anupam, see, like you rightly said, home loans kind of came into existence, I would say around 20-30 years back. Now, and I would say they've seen a drastic change since their evolution. And I would put it across in three broad categories, the changes that we've seen. One is transparency, the other is technology, and the third is basically the regulation that governs around it. Now, from the technology part, right, if we were to see earlier when home loans had just started, the consumer was actually required to go to the bank branch and then ask for a home loan. So it was a very, I would say, tight kind of a product where the consumer would always be thinking, will I be getting a home loan? What are the processes? It would kind of be a very intimidating process for a regular customer who would not know anything about, let's say, a loan or the financial product. But today, what we see is that with the advancement of technology, there is a lot of things which have become easier for the customer. Okay. Like today, sitting here in this room, I can actually apply for a home loan across banks. Wherever I need to go, I can go and log on to the bank's website. I can go and check any aggregator. And on my fingertips, I'll have all the information readily available. And as a consumer, I can then take an informed choice. This also includes my application setting, which today can be straight done right sitting in this room, and it goes to the bank. So that's the technology. The second is the transparency. Now, if we were to look again, going back 20 years, when the loans actually started, there was very minimum transparency. Yeah. Customer would not be actually aware of what are the rate of interest, what are the other charges. Even if they were aware of the rate of interest, they would not know what are other charges, what are the foreclosure charges, what are the prepayment charges, etc. So the other thing which has really evolved is the transparency part of it. Fixed versus floating rates, so many other options which are now available with this thing coming in. And the third is regulation. Over the years, we've seen the regulations get tighter, yet consumer friendly.
Okay.
So there have been multiple initiatives, both from the government as well as the regulator, to make sure that the product evolves in a good sense over a period of time. Let's say there are products like the Pradhan Mantri Awas Yojana, which have now come in. The regulator has also formulated the RERA Act, which overall streamlines the retail industry as such, the real estate industry as such. So I would say these are the 2-3 factors which we've seen evolve the home loan over the years.
Yeah. I have to ask now that even though the product has evolved over the years and it's now the first choice that anybody goes to for buying a house, like uh, taking a loan, what would be the most common mistakes or even myths that customers have when it comes to a home loan? You mentioned a lot of things here. You mentioned, for example, processing fees,
Correct.
foreclosure charges, prepayment penalties, RERA, titles, checking, all of that which has to be done. Home loan is a fairly complicated product as
Correct.
compared to, say, a credit card where you just sign up, start spending and repay and that's it.
Correct.
But a home loan is more technical. Okay, and in today's day and age where information is available to everyone, okay, including shows like this, what are still some of the common mistakes or myths that you see a lot of customers making when they go in for a home loan?
Right. That's a pretty interesting question and an important one as well, Anupam. So, see, I would say broadly, I'll touch upon 2 or 3 main points which customers actually do not realize while they are going to take a home loan. And the most important, I would say, to start with is they overestimate their paying capacity. Now, every customer, I would suggest and I would request them to do a budget analysis at their end before they start thinking of a home loan. Because we have to look at the fact that this is not a short-term commitment. Like you rightly said, a credit card or a personal loan, right? These unsecured products are short-term commitments. You take a credit card, you swipe, you pay within the next 30 to 45 days. But a home loan, you are committing for the next 15 to 20 years of your life. So a customer needs to take into consideration the fact that if whatever interest that they are taking, be it floating or fixed, they need to realize that there would be fluctuations in the market if it's a floating rate of interest and their EMIs could change over a period of time. So that I would say is the most important factor to keep in mind once you are selecting a home loan, or rather a mistake that generally people do. The second important thing I would say is people generally tend to ignore the power of the credit score. Now, just briefly touching upon for the audience here in terms of what a credit score is. So, basically, a credit score defines your history of repayments, which is consolidated by the banks and given to a credit bureau, which then sees that if your all payments are on time, there are no delayed payments, they will allocate a score to you.
Yep.
And that score ranges from 300 to 900.
Correct.
Anytime your score is, let's say, below a 700, I would say, and that's a thumb rule, that score is considered to be a riskier profile. So the moment you go below 700, the bank or the lender will then look at you as a risky profile and your rate of interests may change.
Yeah.
If not that the case gets rejected overall. So many banks have now come up with a risk-based pricing as well. So the lower the bureau score, the higher the interest that the customer has to pay. So being in touch with what your bureau score is becomes really, really important, and everyone I would recommend should check their scores periodically. The third thing I would say is not researching enough, that what are the options available. See, because today, like we discussed, with the advent of technology, you have the world in front of you. You can just understand which bank or which lender is offering you what. And there are so many different products that have now evolved over time in home loans. It's not the plain vanilla home loan. So doing your research in terms of different things and not just the rate, but what is the loan amount that the bank is offering, what is your LTV, which is the loan to value, which will also depend what is the upfront margin money you need to pay to the bank to start with. What are the other charges in case the rates go up? How long does the bank take to revise them? Or if they come down, how long does the bank take to revise them? So overall, I would say this research also becomes really important. And the last one I would touch upon is planning for any contingency. And that's where I feel most of us fail, even if we cover the first 3 parts of it. Because planning for a contingency and having that plan ready with you, Anupam, I would say is one of the, again, most important factors. Because like we saw very recently in the times of COVID. There were job losses, there were salary cuts, and suddenly everything came to a grinding halt. So I would always recommend to all customers to at least have a 3 to 6 month contingency plan ready with you just in case there is any unfortunate event that happens. So these are the 3-4 mistakes I would say that people generally commit. And if taken into consideration, a home loan is one of the best products to have.
So before I go into the interest rate discussion, Abhinav, what I wanted to know was, since you mentioned, what is a good loan to value is given by the bank. But
Yes.
when you say that people overestimate their capacity to repay or their capacity to absorb a loan, in general, if your salary is 100,
Yes.
what is a normal benchmark for me to consider when I'm going and taking a home loan?
So I would say, as a thumb rule, we should not exceed more than 50% of our salary towards a home loan. And that's also, I would say, the upper limit. Like you said, 100 rupees may, if you have as your monthly salary, don't go over 50. And that 50 is a stretch. Anything between 25 to 35, I would say, is a safe zone to play in, because then you have your other expenses.
Sure.
And like I said in the first question, everyone should do their budget analysis. And what that budget analysis means is you need to divide that 100 rupees into what your liabilities and spends are, and then see what is left. Or you may even have to cut a few of your spends, which is fine, which is absolutely fine. Let's say you are planning every year you are doing a vacation for 1 lakh. You can decide to cut that, but then you don't have to cut the most essential spends, and then that spread becomes so small.
That's an interesting point. 25 to 30% of your net take home should go towards servicing your EMI.
Yes.
Okay, interest rates. Very technical topic, very difficult one also. You mentioned about how banks are, when the RBI does anything on the interest rate, banks don't immediately either pass on that benefit or increase the rate. So I think let's start with sensitivity. As in, I have already taken a home loan. Now, what is the sensitivity of change in rates? First of all, how does it work? It works on my EMI or it works on my tenure or both. And let's say roughly 10 bips of interest rate going up or down, how does that affect my home loan?
Right. So, it's a pretty relevant topic again, Anupam. So, see, basically what happens is this sensitivity comes into play when you have a floating rate of interest. Now, how the rates actually change, I'll just maybe touch upon that for 30 seconds. Now, why does a home loan rate change? That happens because RBI, due to some external economic factors, will change the repo rate.
Okay.
And what we've seen that the repo rate was increasing post-COVID, and today it's at a roughly around a 6.5%. Now, repo rate is basically the rate at which the bank gets loan from the central bank. So the moment a repo rate goes up, the banks in turn transfer that additional interest to the consumer in the form of a rate increase. So basically, this is how a rate increase happens, and it can happen vice versa also. If the repo rate goes down, the rates will actually come down. So it moves both ways. Now, sensitivity is on both the aspects. It happens on EMI as well. It happens on the tenure as well. Now, when sensitivity is easier to manage is when the rates go down. Because taking the example of, let's say there is a 100 rupee EMI that someone is giving, and the rate goes down. In this case, the EMI is to reduce from 100 rupees to, let's say, 99 rupees.
Sure.
Now, what the bank will do is, because it's an operational hazard to go and change the EMI or the mandates for everyone, thousands and millions of customers, they'll actually adjust the tenure. They'll keep the 100 rupee EMI the same. And from a tenure of, let's say, which was 60 months or 120 months, they will reduce the tenure so that your overall liability reduces.
So I'm going to just step in here. Is this a choice they give me or is it enforced on me?
So, no. it is actually a choice. So what the customer can actually also do is they can go for a reduction in their EMI as well. So that option is there. But generally customers don't use that because you are already used to 100 rupee EMI and you've done your budget analysis. If you've done it rightly,
And it makes more sense to reduce the tenures.
you will be you will be comfortable paying that 100 rupees and then reducing your overall tenure, which actually brings down your interest liability through the life of that loan. So that actually makes sense. But that option, like you rightly asked, is available to the customer.
Okay.
Now, where the complexity or maybe the difficulty comes in when the rates go up. Rate goes up, the 100 rupee EMI now needs to be paid as 101. I, as a customer, have already done my budget analysis and I am unable to pay that 101 because there is a difference in EMI now. So what the bank does is they will say, okay, your tenure, which was 120 months, is now increased to 130 months because you are not increasing your EMI. And in this case, the reverse happens. Instead of your interest liability coming down, now your interest liability goes up. So initially when you started the loan, if you had your overall interest as X, now you are going to pay X plus Y. So, and again, here also you have that option of doing it or not doing it. But then this is how the overall rate sensitivity plays, and it's very important to be aware of what your rates are, and especially because during the last 2 years, we've seen these rates go up, and in fact, EMIs went as high as 20%. So someone who was paying a 50,000 rupee EMI on a home loan, at the end of those 2 years is now for giving a 60,000 rupee EMI. So almost a 20% jump. So all of these factors really play out.
I mean, if I've got my numbers right, interest rates have gone up, repo rates, which are the benchmark rates, have gone up from 4% to 6.5%.
Correct.
So 250 basis points, so 2.5 percentage points,
correct,
depending on how you see it. Someone who took a loan at 4%, okay,
right,
I don't know whether it's fixed or floating. I'm going to just get into that later.
Right.
So you are saying that from 4 to 6.5% of increase in repo rate, my EMI would have gone up 20%.
In that ballpark.
Roughly,
In that ballpark.
And you know, folks, if you're wondering that how do interest rates work, it's just as simple as inflation works. If you are going to your local coffee shop, if the coffee beans price go up, your coffee is going to go up. If it goes down, hopefully the coffee shop passes on that benefit to you. The only difference here, I think, is that the RBI is there to ensure that these rates are transmitted so that your home loan either gets a benefit or gets hiked up.
Okay? That's where the regulator comes in, Anupam. And their job is to see that if the repo rates have been reduced within a stipulated time, all banks bring down their rates because that benefit needs to be passed on to the consumer end of the day.
Okay, fixed versus floating. Now, here's the thing.
Right.
He's sitting at 4% repo rate. It's one thing for someone who's taking a home loan. If he's taken a fixed rate, good for him. Okay. But if he's taken a floating rate, now he's got to pay the price.
Right.
6.5%, I think, let's start it in such a way that what's your outlook on interest rates going from here? And therefore, what would your advice be to a viewer or a listener who's looking at this right now and he's wondering, what should I do, fixed or floating? He wants to take a house.
Right.
He doesn't know what to do, fixed or floating. Okay.
Right.
So, two-part question. First, where do you think interest rates are going?
Right.
Okay. And what's your advice to someone who's taking a home loan today?
Got it. So, Anupam, basically, the outlook currently is that the home loan rates have kind of peaked. Now, I'll take a step back and again explain why the repo rate is set to go down. These repo rates were actually increased by the RBI as a measure to control inflation. Because our inflation was going high, the repo rates were increased to reduce the amount of money circulation in the market. Now, the moment that happens, the interest rates went up. In the sense of what it holds for the future, now inflation is well under control. Not still there where RBI would have wanted it to be, but it's almost there. So what the industry now feels is that in the next quarter, 1 or 2 quarters, the repo rates will be brought down by RBI. And once that happens, there will be a reduction in the home loan interest rates as well. So the outlook is that home loan rates are in the next couple of quarters set to come down.
Sure.
Now, what should a consumer be looking at doing? And you asked the second part of the question where if a fixed or a floating works. Actually, I would answer it this way. There is no straight answer to this, Anupam, fixed versus floating. And it all depends on the individual's choice or individual's current situation where they are. And just to explain to everyone what fixed versus floating is. So when you enter into a fixed home loan, for a certain period of time, what the bank guarantees or the lender guarantees is that for this time period, we will give you the rate at this percentage only.
Yeah.
And it will not vary basis the market fluctuations. So the benefit of a fixed rate is that the consumer has a peace of mind that tomorrow my EMIs, like we discussed previously, are not going to go up by 20%.
Yeah.
So you can sleep with that piece that, okay, I have done my analysis,
Yes.
my budget allows for X EMI and it is not going to go up for the next 10 years.
Yeah.
That's the piece it comes with. However, at the same time, fixed rates are a little higher than the floating rate.
Correct.
So if the floating rate is at around 8%, the fixed rate would be given at a 8.5%. So that 0.5% ka premium is already taken when a fixed rate is given, and that's the price you pay for getting that peace of mind.
Yeah.
What is a floating rate? Floating is that rate which fluctuates with market. It's related to the benchmark rates. And what happens is, it can give you a positive as well as a negative. So the positive is that tomorrow if the rates fall, your EMIs will fall. But at the same time, if the rates go up, your EMIs will go up. So this is how this fixed versus floating is structured. And there is no straight answer, Anupam. Like I said earlier, it all depends on the personal capacity, on the person's situation. They would have to do their analysis and see what works best for them. Generally, what we see is that people go with floating because people want to take that advantage of that falling market rates. Ki tomorrow, if the rates fall by 1 or 2%, if I am on fixed, I'll not get that benefit. But if I'm on floating, I'll get that benefit. Yeah. So that's what generally people do. But then again, it's an individual choice.
How does it work? See, it's a 10-year, 15-year, 20-year loan. Do banks give me the opportunity to switch between fixed and floating? And if they do, which I think they do,
yes,
does it come at a cost?
So what happens is that you are allowed to do that switch in between, but then there are certain charges which the bank will apply. And then there are also cases where there could be certain lock-in periods that you've locked in this loan for this period at this rate and you're not allowed to do that. But after that tenure, you're allowed to do that.
I think the answer is fixed or floating depends on your situation and your condition.
Correct.
As of now, at least it looks like interest rates will be on their way down. When and how it happens, we don't know. Right? Because there are so many global imponderables also.
Correct.
Today you wake up, it's a World War III.
Yes.
Tomorrow you wake up, something else has happened.
We hope not.
We hope
yes.
not, yeah. But, that's not part of this discussion. But I think the simple answer is you should be checking your budget, your finances, your repayment capability. That is more important than fixed versus floating.
Correct.
Okay. Now let's get into something, which is a little bit tricky. What happens if I find it difficult to service my home loan? Okay.
Right.
Job losses are there. Salary cuts are there. If you've got a 10-year or a 15-year loan product, a lot of things can go wrong in your life. You yourself mentioned about contingency.
Right.
So how does this work in a home loan when things become difficult for me to service or to repay my loan?
Again, a good and an important question because I think at some point of time, most of the people do find it difficult, challenging because of various personal circumstances. Now, see, the first thing we should do when we find it difficult to furnish a home loan is reach out to our bankers and have a very open chat with them. Because, see, this is a fixed asset. Now, generally, what people do is they buy one home and they take a home loan on it. And it's the asset where they live, right?
Yeah.
Now, we don't want a situation to arise where we've been defaulting on our payments and then the banks comes back and says, hey, this is a NPA and now we need to do certain legal actions and to
Repossess or something
repossess
like
the
that,
house and all. So the first thing we should do is go and have a very open discussion with the bank and tell them that this is what the situation is. In that situation, there are multiple options available. So bank can actually come back and say, okay, let's work at refinancing your loan. So let's say you've been given the loan at X percentage. We are ready to reduce our interest by a certain percentage. Now your EMI would reduce by this much. Are you comfortable? Right? So in most of the cases, that person will say, yes, this looks. So earlier, let's say if it was 50,000, now it's coming to 40,000. Okay, I can still manage that. Right? So that's one option. The other option that the bank can actually give you is, why don't you take a break? Like they'll say, okay, 3 months, 6 months, you get your things in order. We'll not hit your account for those repayments, but please make sure after 6 months. So it's basically a moratorium that the bank can give you as a gesture. So these are like 2-3 things where the bank can actually help you. Then there are a few things that the customer can actually do on their own. Yeah. Let's say I'm running a home loan and I fall into some bad finances, but I have certain assets, right? Let's say I have gold at home, or I have certain other assets in the form of a car or other personal assets. I can actually look at liquidating those assets and furnishing my home loan first, either as a part payment or as a full payment. Because the moment, even if you do a part payment, right, you bring down your liability of that EMI, even if the bank doesn't help you.
Sure.
So if your loan outstanding was 50 lakh and you bring it down to 40 lakh by giving them 10 lakhs from, let's say, breaking a FD or
giving gold or
whatever, selling that off. Now your EMI is on 40 lakh instead of 50. So automatically your EMI comes down. Just one thing to keep in mind here, Anupam, is when you are using your personal assets or personal finances to foreclose, make sure that you use that money which is giving you the lowest interest possible. So don't take out money from the higher performing assets. So first use the lower performing assets which are giving you lower interests than the higher ones. But if need be, then you have to do it from that personal front. Sure. So there are both options that I would advise a person to go with. Speak to the bank, foreclose, and part payment.
Most important thing is to speak to your bank and have a relationship with them and figure out the way forward. Abhinav, now there's a lot of technology in your platform. There's a lot of data that you get and analyze. I want to ask this question in one way, that who is an ideal candidate for a home loan and who is not? Okay, let's look at it in a way that now everybody wants their own house. Let's just say, without going into the rent versus buy debate, which has gone into a different zone, but it's a legit dream.
Right.
I want my own house. Okay.
Right.
At the same time, not everyone can afford their own house or a home loan. People, like you said, get into a home loan overestimating their repayment capacity.
Correct.
Okay. So, in your view, who is a good home loan candidate and who is not a good home loan candidate? Like, at least as of now. They should become at some point of time, but for our viewers and listeners out there who are considering to take a home loan, what would be some markers for them to consider before jumping in?
So I would say the first and the primary marker, Anupam, is how your bureau is and what your bureau score is.
Start with your credit score.
Start with your credit score.
Okay.
And the banks will always do that.
Which is one way of saying that home loan should not be your first credit product.
Yes.
Okay.
So see, generally what happens is that you start with, let's say, a smaller ticket size loan, you take a consumer durable or you take a two-wheeler as you start your career, then you migrate to a credit card, then a personal loan, and then an auto loan, and then home loan actually comes almost like once you are a little mature, you've started your...
What happens is the old traditional Indian thinking used to be salary aaya, first thing is a home loan. Okay? So now thoda...
अभी वो चेंज हो गया है. अभी वो धीरे-धीरे चेंज हो गया है. I think with the previous generation, people don't want to take a liability upfront, huge liability. They want to enjoy, they want to spend a little till the time they are a certain age. But yeah, coming back to the original.
The credit score.
Yeah.
What's a good place to start there?
Yeah. So I would say anything above a 700 is a thumbs up for a home loan product. And we'll have to keep that in mind that, see, this is a secured asset, right? It's a secured loan. It's backed by an asset. So bank can take a little more risk here because they know that the asset is in the bank's name and they have the power to repossess it. So I'm saying 700 is that credit score. Uske niche bhi we've seen loans happening, because now, see, we've seen a lot of the entire horizon of lenders. Right now we have HFCs, NBFCs also coming into that frame. So they may charge a little bit extra, but they are ready to fund a riskier home loan profile. But as a thumb rule, I would say 700. And then there are other factors that the bank will look into an ideal customer. The previous repayments obviously should have been on time. Then the profile of the customer, where are you working?
Profile is very tricky. So one is, I've heard that this algorithm it's quite dynamic.
Correct.
Which city you're from, where you're working, etc.
Correct.
Can you just walk us through that?
Right. So see, there is something called application score that most of the banks now work upon. Now, it's like the Google algorithm. No one other than the creator knows how that works. So even me, who's been in this industry for the last almost 18 years now, I would find it difficult to exactly pinpoint and say that this profile purely on the application score will go through. Because like you said, it takes into consideration a lot of factors. Which city you live in, which company you work for, is that company a categorized A company, B company, C company, uncategorized company? How many dependents do you have? Then which area in that city you live in? So the application score is actually a algorithm which runs in the back end, taking into consideration these maybe 50, 60, 100 data points. And then it throws a score. So it says now the customer is a pass or a fail or is a referred. So referred will be taken as a little bit of a more checks that the bank would want to do. Pass, they would say, okay, the customer has passed. So that's how basically the application score works, other than the bureau score. And now what we see is that most of the lenders take a combination of both. Bureau plus application score, and then they will qualify a customer.
So we've got credit score, we've got job, more years of experience, good salary. These are all some factors.
Stability at that current residence. How many years have you been living there? Is that residence that you are living currently rented or is it owned? Then in the case of home loan, it will also depend on what asset, what house you are going to buy. Which builder is associated with that product. Is that builder listed with the bank or not? If not, then they will do a separate check of the builder and his credentials. So, see, home loan is a pretty vast, it's not as simple as a personal loan or a credit card. A lot of moving pieces there.
I mean, if you continued a little bit more, I would have thought that you're trying to arrange for a spouse or a marriage proposal out here. Okay, the kind of list of things that you're proposing. Very interesting.
It's almost getting married to the home loan itself.
But in general, no two banks or no two NBFCs will have the same process. So the more you search, the better it is for you. Okay, and that is in fact going to be my next question. I want to get into how to choose a good home loan. Now that we figured out a good candidate, there's someone who's watching our show now wants to get into a good, wants to actually go in and buy his dream home. How do you choose from so many banks, so many NBFCs out there? And this is something that you do. You are an aggregator. You help people take an informed choice.
Correct.
So what would be your advice, your checklist or a list of tips for people to choose a good home loan?
Generally, what people do is they will look at only one criteria while choosing a home loan, which is what is the rate of interest I am getting.
Wow.
Because that is what people have been talking about. So you always speak to friends and you will say, oh, I'm taking a home loan. And the first question will be, अरे अच्छा बहुत बढ़िया क्या rate पे मिल रहा है? Right? It's like वो क्या rate? So generally people get fixated on that interest rate and they forget to think about other things which are also equally important than the interest rate. That which brand are you taking that home loan from? What are the hidden charges, if any? Have you read the fine print in terms of tomorrow if you have to part close or if you have to foreclose, what are the conditions that the bank is going to impose? Tomorrow if you have to do a balance transfer, which basically means that you want to transfer your loan from lender A to lender B at a lower rate of interest, what are the terms and conditions that the bank has? What is the TAT, most importantly? Again,
Turnaround time. Yeah.
what is the turnaround time for the bank to approve your loan? Uh, does the bank actually have your builder as part of their approved list or not? Because then the process is
Simpler.
very simple.
Yeah.
But if they have to onboard then that builder, then it will take a decent amount of time for them to kind of come back to you with that approval. So multiple such things which people have to keep in mind before choosing a home loan. One more thing I would say is, what is the loan to value, right? Let's say one bank or lender is giving you a 80% LTV versus the other is giving you a 75%. What this basically means is that if you are buying a 1 crore property at a 75% LTV, you are getting only a 75 lakh loan.
Yeah.
Whereas the other bank will give you a 80 lakh loan. So that 5 lakh additional you can actually save.
Yep.
And not save. Generally, people don't have that much money when you're buying the home loan. So you don't have to arrange from other sources. So all of these things, what is your LTV? What is your turnaround time? Is your builder listed? Is the property that you're buying listed with that bank? Then what are the charges? What is the processing fee upfront? Because on a large ticket size loan, and this is a fairly large ticket size loan, the average ticket size in the industry is around 40-45 lakhs. Even a 0.1% additional processing fee can be like 5,000, 6,000 rupees. So all of these things really matter. And I would just advise people not to only look for the interest rate, but all of these combined factors before taking a decision.
I want to just walk through a few points that you just mentioned. One would be, we spoke about fixed to floating.
Yes.
That would usually come at a charge?
So the fix will be a little higher.
No, if I want to switch regime from fixed to floating, floating to fixed.
Right.
The bank will charge me for that switch?
After a certain period, yes, they can.
Prepayment?
Prepayment, no. If you're closing from your own funds, then the bank should not be charging. But if you're doing a balance transfer, which means you're closing that loan using the other bank's money, then there could be a balance transfer charge.
So all of these will be mentioned in the loan document.
Correct.
And you should at least speak about these 3 or 4 points before entering into the home loan.
Correct.
Okay?
Correct.
I mean, folks, so that's a fairly long list. And at Mind Your Karza, like we said, you have to understand the implication of all of this. And out of all the episodes that we're doing, we know that the home loan is probably the biggest of all credit products that a retail consumer will ever go in for. And therefore, it becomes even more important for you to check every fine point, every fine print, every terms and conditions going into that.
I would just add here, Anupam, home loan is a long-term commitment, right? It's just like how when you get married, you check each and everything in your partner, even if it's a love marriage or an arranged marriage. Home loan is something similar because you are going to be committed to this loan for the next minimum 15 to 20 years of your life. So do all the due diligence possible before entering into this kind of a contract.
Yeah, and of course, a home loan can unlock the dream home of your choice, which makes it, that is a benefit that you get of taking in the home loan.
Correct.
Yeah.
Absolutely.
I believe we've covered all the details, but for more, you can always check out the Bank Bazaar website. With that is a wrap on this episode of Mind Your Karza. My guest, Abhinav Kaul, Senior VP Partnerships at Bank Bazaar. Abhinav, thank you so much for doing this for our listeners.
Thank you, Anupam. It was a pleasure.
Thank
you so much.